Good morning. This is Dylan Jovine with Behind the Markets. Today I wanted to talk about a note out from Raymond James last week. They analyzed how the yield on the 10-year Treasury bond impacts stock prices. And remember something, all investors, professional investors, use the 10-year Treasury bond as one of the key pieces of an equation we have to value stocks, to tell us what stocks are worth. And I'm not going to get into the details of that now. That's for another video, or actually probably a class. But I'm going to tell you this right now. In this Raymond James note, it really goes to show you how the inverse relationship between stock prices and yields on the 10-year Treasury. When yields on the 10-year Treasury go up, stock prices go down. When yields on the 10-year Treasury go down, stock prices go up. It is just this kind of relationship. It's a seesaw relationship. And ladies and gentlemen, let me tell you right now, the 10-year Treasury is going to determine the stock market basically more than anything, really. And what we find in Raymond James's research note is that basically whenever they're below 4.5%, stocks do well. They go from 10 to 15% returns in those years. But the minute they hit 4.5%, returns get down to 1%. If they're 4.6%, days that the Treasury yield was at 4.6%, the markets returned minus 2.4%. And days that the yield was above 4.7%, markets were down 35%. So you have to understand something, that again, we have a situation here where the yield on the 10-year Treasury basically determines the interest rate for, it's the price of money basically. It determines the interest rate for so many things. So many assets are tied to the yield on the 10-year Treasury. And it's very important for us to understand. A lot of folks, when they wake up in the morning, they check the market. Let's see how the Dow's doing. Let's see how the S&P, the Nasdaq's doing. You should be adding the yield on the 10-year Treasury when you look to see how the market is doing. You should really be looking at that. And now the fact that Moody's has really downgraded U.S. debt, that has gone up a little bit. So this is going to continue to put pressure on the stock market, general pressure. Now, over the 30 plus years, almost 35 years, wow, that I've been doing this, what I've learned is when yields start to get this high, it's regular companies with average earnings growth, 10% a year, 7% a year, they just start to feel an immense gravitational pull downward when yields get this high. They just start getting pulled downward. But exceptional companies with super high growth rates in super high industries, they also feel the gravitational pull downward, but they have their earnings and their growth are like a rocket. It's like a gravitational pull, pulling the stocks down. But a lot of companies, a handful actually, can actually have a rocket effect where they're able to pop out of the gravitational pull of these yields, high yields pulling them down. And companies that do that, in my 30 plus years, almost 35 years doing this, are companies that win massive contracts, partnerships, big partnerships. And this makes me think of the $1 trillion defense budget that President Trump has passed, where it's basically going to be pouring over 120 billion new dollars into a handful, maybe under 10 actually, defense contractors. Now, 6 of those defense contractors are big, but 4 of them are really small. So getting a piece of that, getting a few billion, 3 billion, 5 billion, 10 billion is going to blow up their stocks. And we talk about this in our Iron Dome webinar. I hope you get a chance to watch it again. But you keep an eye out for the yield on the 10-year. When you wake up in the morning, look at the Dow, look at the S&P, look at the Nasdaq. Also look at the 10-year Treasury yield. That is going to tell you more about what happens in the market that day than any other single indicator right now. Anyway, that's all I have. Have a wonderful day.